Netflix reported second quarter earnings today, which beat management's expectations on almost all metrics, with the exception of contribution margin percentage. After the company reported, shares jumped to $108, which represents a 10% increase from the close at 4 p.m. today. Today, in this video, we're going to take a look at whether or not this 10% price move makes sense, and we're going to use our earnings model to make that determination. Before we do that, I'll just walk you through really quick for new users who aren't familiar with our modeling approach. Our model format is relatively simple to understand. We have this color legend in the upper left-hand corner, which tells you which cells represent our estimates. The purple cells represent company guidance, and the orange cells represent consensus estimates among Wall Street analysts. So the view we're looking at right now is pre-earnings, so this does not include the results that were reported today. You can see we use two valuation approaches, a multiple-based approach and a discounted cash flow approach, and our 12-month price target is based on a 50-50 weighting of the two approaches. It starts with the income statement. Then if you scroll down, you'll see I have some different sections here just to make it a little bit easier for people to look at. We have segment details, so if you expand this section, you can see we have domestic paid members for each quarter, quarter-on-quarter growth, average paid members, domestic streaming revenue, all of the metrics that you need to build the income statement up above. We also have the same details for international streaming and DVD rentals. So I'll just collapse these once again. We also model a full balance sheet cash flow statement, which we use for the discounted cash flow analysis. I realize that most people just model earnings and use a multiple-based approach, but the details are here if you'd like to model the full financial statements. Down here we have the details of our discounted cash flow. If you'd like additional information on this, please visit our website, www.gutenbergequityresearch.com. If you go to our model store, we have a detailed video, 10-minute video, that explains our discounted cash flow approach. And while you're there, if you'd like to download this Excel file, you can scroll down to the Netflix earnings model and purchase it for just $5. So if we go back to the model, you can see that we calibrated it to consensus estimates prior to the release. And anywhere you see comments, you can see management's guidance from the previous quarter. So obviously, the street is not always in line with what management had guided to, and this information will tell you if if it's a little higher or a little lower, and you may want to adjust your own figures to meet management guidance. So let's put the pre-earnings view side by side with the updated after earnings view. And even before we do that, I should show you the other tabs that we have in our models. So if this is too much detail, you may want to use our back of the envelope valuation tool. Again, the orange cells represent consensus estimates, and the other cells represent our estimates to fill in the blanks and get you to your bottom line EPS number. For this analysis here, there's no discounted cash flow. We simply use the multiple that shares were trading at just before the press release went live, so you can change this to whatever model you want, and then right after earnings you can update just this section, and if you leave everything else constant, it'll tell you exactly what shares should be trading at. So again, this is a pre-earnings view. You may also be interested in what one specific analyst estimates results are going to come in at. So if you look at, you can just pick any of them here, so maybe Oppenheimer, and maybe you follow this analyst and you want to recalibrate the model to his estimates, you can do that. You have his recommendation, his price target, pre-tax profit, net income, sales, earnings before interest and tax, and his non-GAAP EPS estimate. So this is for the next fiscal quarter, and if you scroll down, you'll see the other quarters wherever the information is available. We also have a little section here that'll fill in the results after the earnings are released, so you can just quickly see where the actual came in relative to the consensus, and also if the company gives guidance, where it stands relative to the next quarter. So let's go back to the model, and put the pre-earnings view side by side with the model that we have now updated to include the details from the shareholder letter. So if you scroll up, Netflix management gives us all kinds of details for the next quarter estimate. So we've gone ahead and filled these in. We've filled in the actuals for the entire financial statements. And you can see we no longer have orange cells because the consensus details won't be released until later this evening. But we do have these purple cells, which represent management guidance. So now with the new details for the month or for the quarter of June, and the new details on paid members, streaming revenue, and contribution margin for domestic and international streaming, and new EPS details, we get to our new price target. So it's interesting to note here, if we put this side by side once again, that the multiple-based valuation has increased pretty significantly, and the DCF has actually decreased. So the reason for that is the discounted cash flow valuation looks out to much further periods in the future rather than the next 12-month earnings, and are based on management's guidance of the number of paid members and the contribution margin. The cash flow from operations is actually lower in this updated model than it was in this one, which is an indication that the number of users, while it's still increasing significantly, and management, the users did beat management's guidance for the second quarter, it was probably a little bit lower than what the consensus estimate was modeling. So you can see the DCF has come down. So even though short-term earnings look pretty good, there's a little bit of an offset there. Using our 50-50 based valuation approach, though, shares, this indicates that shares should be trading at about $105, give or take. So the $108 price overall is probably reasonable. Be sure to check back in a few days after the consensus estimates have been updated. We'll update that section on here and recalibrate our model. Thanks for watching.